to talk it through, but I like to, when we talk about the capital stack, there are some visuals that are pretty important to help understand.
If you can email them to us, that'd be great.
I'll just sketch it on a napkin for you right now. How about that? That'll be good. So no whiteboard today, but we'll get there. So I think one thing I like to start with is just terminology. So much of this stuff is just terminology, and you may not get it right away. And it may take a while, but the more you hear these things, it's just a language, right? You guys, and as we know in real estate, you veer off just one little bit, and it's a different terminology and different lingo.
Not a Sharpie.
Oh wow,
Jeff, that's gonna. Oh my
does it erase?
God. That doesn't
You
erase.
just used a Sharpie on
You
your
may want
glass.
to wipe that.
If you use a dry erase marker, will actually get rid of that. Do a dry erase marker over it, and it'll come off. No, that won't work, Katie. Katie, that won't work. You need a dry erase marker on top of it.
Bullshit, it works.
Oh, you are so lucky, Smith.
Wow.
So that said, let me show you the yield curve. Thank you, Katie.
Oh my gosh.
She cleans up my messes.
Hey, it might make us look good if we have yield
Yeah,
curves
dude, yield
and
curve shit all over
Make you guys look really smart, huh?
Yeah,
Leave
people
it on
walk
the
in there
window.
like, whoa, we're not in the right place.
Yes.
So for you guys on the phone, Jeff just drew a Sharpie on the glass conference. So, getting back to the task at hand here. So terminology, there's a lot of things you may hear, but just know that the more you hear it, you start to understand it, so don't get frustrated if you don't understand it right away. The other thing I like to say is capital can be, it's kind of like math as a kid. I mean, it can be so complex, but it can also be, it's really simple. You think about it. The things we'll talk about today are really pretty simple. And then you can take it a whole different level, but recognize that and don't be scared off by it, and you guys will get it. And so I think those are a couple important things to talk about. If I get into, I'm just kind of looking at my notes. Oh, my last disclaimer was the fact I've been on vacation for the last week and a half, so
The facial hair.
bear with me. Yeah, I got this half of a beard on me and half of a brain maybe too, but I'll have to kind of get in the game here. So, and Sims may want to back me up here, but one thing we talked about with capital, it's a little bit different in your world as I was thinking about it, because you guys, there's no income, which is a whole different deal when you talk about debt and even equity too, with how it impacts returns. They're generally, a lot of times they're unleveraged, so you don't have debt to talk about, and that kind of tweaks it. And if you do have debt, it's generally low leverage, and it doesn't quite have the impact that you have on a commercial deal. And then also you have home builders that they have an entirely different capital structure and cost of capital. So when we talk about, we'll get into joint venture structures and how those are laid out, but it's going to be a little bit different. So with you guys, a lot of what it goes back to what I talk about in the metrics and debt and different types of debt. Because when we talk about debt, there's permanent debt. There's CMBS, if you know about CMBS. There's insurance kind of debt. There's bridge loans. And we'll get into some of that, but a lot of it doesn't apply to you just because so much of what you guys look at are unleveraged type of deals. And at the end of the day, an unleveraged return is really the best way, as you guys probably know, the best way to look at a deal, because then you're taking out all the artificial bullshit that people use to kind of craft the returns that they want to get to. Now, in talking to Sims last night, one thing that I want to critique how you guys look at deals, and perhaps you guys look at it a little bit differently in this, but from my understanding, you guys look at things on a margin. And when you guys try to back into whether a deal makes sense, it's a 10% margin. The deal must make sense. But what you guys are missing there is you're not taking the components of the capital into consideration and what that cost of the capital is into consideration. And so when we look at a $10 million deal and you guys have your $11 million of revenue, let's kind of throw that out for a moment and let's say I got $10 million of cost. And what does that capital consist of, and what does that cost? Now with debt, there is leverage and there's rate. I mean, those are the two simple things. And you know, again, we talked about bridge lenders a little bit. We talked about hard money lenders a little, you know, there's hard money lenders, there's construction loans, and those are all priced at different levels based upon what the risk of the deal is gonna be. But for you guys, you really need to understand what is the cost of the capital, because that is impacting that $10 million that everyone thinks is the cost, could have a pretty big impact on that. And is the rate 5% or is the rate 10%? And you know, certainly that has an impact. And then along with that, another big component that we're seeing a couple deals right now, when you have kind of shorter term bridge loans, is there a lockout provision? And there's some terminology. And the lender would say another kind of highly sophisticated terminology kind of thing is there call protection from the lender? Because lenders don't want to have their money out for 3 months. And we have a couple of deals right now, you know, one with Shop Off that is, he may not need it for that long. He may only need it for 3 months. But we can't underwrite the cost of the capital as being 3 months because lenders want to have that money out ideally for, you know, a 12-month is a good minimum that they want to see. And that's going to be our negotiation point is we're going to say, we don't want 3 months of capital. But from the capital's perspective, it's kind of a waste of time to do all this work, to do the underwriting, and then get your money back in 3 months and not really have your money working for you. So, yes, and please, anytime.
Are we permitted to ask questions, Doug? We are?
As long as you ask permission.
As long as you raise your hand politely like that.
Can
Yeah, of course. Yeah, please. I want this guys on the phone too. Heavily interactive. I want to make this kind of a group discussion. So if there's yell for you guys on the phone or internally here, just throw your hand up.
Hey, if I'm jumping ahead, then by all means, just let me know. But I think what might be helpful for a lot of people would be maybe just a simple basic explanation of what a hard money loan is and what a bridge loan is. Because you've mentioned them now a couple of times.
Yeah.
And I think, frankly, I don't know that we know what they are.
Okay, absolutely. And
Before
that.
you go, just to clear up lockout, is that, I don't wanna do short term?
That is, you cannot pay this loan back.
So
I mean,
like a
locked out.
prepayment deal.
Yeah,
Okay.
you can't. There's exactly. There's no prepayment, and that's the other thing. That we talk about terminology. One thing to really keep in mind and not get confused. You could have the same thing, and have it be said 5 different ways. You know, prepayment penalty, lockout, call protection. Those are all the same things that you know. So don't get confused when you hear something, and you're arguing with somebody. Say no, so, you know, such and such means this. Well, 2 other things could mean the same thing as well. So, okay, going back a step, and that's a good point. And part of what I want to do is just even talk about debt and equity, because I understood that at some point that you guys might not even know the difference between debt and equity. So, for debt, well, then let's go to debt and equity first. I mean, is that too?
I think you're right.
Jeff?
I think you need to start at the bottom
Yeah.
and work your way up.
Jeff
Absolutely.
tried to give us a debt and equity explanation, but it turned into like an hour on like debt, and I don't think we ever hit equity.
Okay. So let's just, if you have a $10 million.
And it sounds so much better coming from you.
Okay,
So,
good.
I mean,
So let's look at it this way. The 10 million. This is where I want to have my whiteboard, but I don't want to draw
Do
that.
it.
well, you
Go
can
ahead.
do it.
Sure.
Sure, you can do it.
No, not that one.
Oh shit, not this one.
Give me that.
Take that away from
Yeah.
me, fill coffee, cause this is just getting interesting.
Get us some other colors.
Yeah, anything in it?
Why does he have red?
Well, you might
Yeah,
need some
I
other
didn't
colors.
realize there was an
You got
orange backdrop.
Red's a bit different there.
We got green, we
I would
got
want
brown.
brown. That's kind of ugly. Yes, Ben didn't draw
Okay, and
his
for you
eye.
guys on the phone, all I'm doing, it's really simple. I'm just drawing a rectangle. and I'm drawing that rectangle. I'm drawing a vertical rectangle.
Brown may be worse.
Go with red. Go with red.
And in this case, I'm just drawing an arbitrary line at 60% because, and that's a rough. I mean, you guys in land are going to be lower leverage, commercial are going to be a little bit higher leverage. So we'll split the difference, and we'll talk about a $10 million total cost. And so the debt is money that's provided by a third party. So, and you can imagine, you don't have debt, you just have an unlevered deal. And the sponsor comes in and says, I'm paying $10 million, all cash, and as we said before, that's a really good way to look at a return standpoint because that is as clean and pure as a return perspective could be. But then, in order to get better returns, and we're kind of jumping ahead a little bit of using leverage. I mean, leverage is a double-edged sword. It will help the returns of the equity, but it could also crush you. And so,
As Warren Buffett says, it eats like a chicken and it shits like an elephant. So that's debt and equity, right?
now I'm confused.
All right, well, I thought that was good. All right, maybe, I'll keep quiet. I'm
So,
sorry, David.
That's okay. And jump in anytime.
Think twice before you do
So debt, you gotta be careful with it. And it could really come back to haunt you. Now, cause so where this was the sponsor, all the $10 million, he's saying, hey, I don't wanna use all my own money. I can get better returns, and we can get in that in a little bit later, by using debt. The problem is, now you bring in a third party to take over this part of the capital. We call this the capital stack. And now you have a guy that has your ass in a sling. If you miss payments or covenants or whatever, he can come back and take over the property. So there are, when we say debt, going to your question, and so if we call this debt, then what's left is the equity. And just like when you buy, and it's amazing how simple, I mean, my wife is in real estate, but sometimes debt and equity, she doesn't really get it. She's like, oh, the down payment. So I think in a basic, form of residential real estate, equity is your down payment. And just like when you buy a home, you go and get a mortgage, which in the commercial or in our world we call debt. But then when debt has to be broken down into a lot of different levels. There's lots of different, thank you, sir, different kinds of debt. One of them would be, and I'll just quickly kind of go into the commercial side that is less applicable, but when you have a stable property and income is, you buy this building and it's fully, cash flowing, you would put a permanent loan on it. And a permanent loan can also be dissected into a lot of different levels. You have CMBS, commercial, and I know this is where I'm getting off the residential, but because you asked, and we have time, I think it's important for you guys to understand some of this stuff. CMBS, this is what got our world all messed up 10 years ago. Absolutely, I mean, they were the
And what
de
does it
facto
stand for?
commercial mortgage-backed securities. And you also have mortgage-backed securities in the residential market just for buying homes. And those are lenders that are providing long-term, 10-year typically loans, and they're selling the bonds, they're selling them as bonds to retail investors. And what happened back in the day is there was they weren't holding on to the loans. They were just getting rid of them. So if I have no skin in the game, everyone was just going higher leverage, higher up this curve at a lower and lower and lower rate, and just passing them off, and they were getting fees for it, and then that just turned into the mess that we created. So, and now this is finally coming jumping ahead, but there's rules that have been from the crash that are now coming into play where these guys have to retain some of that piece, which they're all up in arms about, but are you kidding me? Of course you gotta retain some of it. If you're making a loan, that's how we know that you're making a good loan. So CMBS is permanent, insurance is permanent, and these are all different. We could spend tons of time talking about, how these different loans are different, and that's a lot of what we do, is when we get deals, it's like, oh, well, that's an insurance kind of loan, or that should be for CMBS type of loan. Another permanent would be a bank, okay? So that's just permanent. But then let's go to a bridge loan. And a bridge is something that is where we call adding value. And it's typically a short-term loan, anywhere from, as we said before, sometimes you might only want it for 3 or 6 months, but they typically don't want it to be out that short, because they want to make enough money on their money. So that's going to be, typically these are 1 to 3 years in length. And what this is saying is that I'm going to bridge you until you get to another event. In commercial, it would be when you buy an office building, let's say, and it's only 50% occupied. You don't have enough income to get a permanent loan. So you have to get a bridge loan to then try to create the value that you're buying the property for, to lease it up, then would stabilize the property, and then you can take out your bridge loan with a permanent loan. On the residential, do you have a question?
Can I safely interchange bridge loan and hard money loan? higher interest rate, more points,
Yes,
shorter term.
that's somewhat fair to say. I mean, I think we'll.
Hey, Dave,
Yeah, yeah.
I think to answer Doug's question on that too, in the residential world, a bridge loan and a hard money loan would be much more interchangeable.
Yes, okay. Because in the residential world, a bridge loan is a high risk. You don't have any
lower
income.
LTV, yeah.
Exactly, and I'm going to charge you an arm and a leg for it.
Yeah.
But it really
Right.
is.
It's just simply the pricing in the residential land world is going to be such that, if you're getting a loan on land, it's going to be close to hard money rates because it's basically the same thing. Whereas on the commercial side, we see those rates down in the 5s and the 6s, but there's a lot less risk there.
And that's a perfect point, Steve. Thanks, because that's how we would differentiate. When we say bridge, in our mind, we're thinking a lower priced loan, probably a little bit higher leverage and a lower rate. Where hard money in the commercial world is kind of that's your loan of last resort, right? And I know I'm going to not get a ton of leverage. I know I'm going to pay a lot of money. And on the residential side, pretty much that's what you have in general.
Can I just ask a quick question?
Of course.
Is that rate just a function of risk then on a land loan, or is there another factor that comes in besides risk?
Well,
it's a function of risk.
Only risk.
Well, and let me add to that. There's and two things are risk of the asset and the property, and also risk of how high up the leverage curve or how high up the capital stack they're going.
Okay, makes sense.
Although, Mish, if you were to look at a commercial deal, on a commercial bridge loan, you're going to get a higher loan to cost than you are on a bridge loan on land.
Right.
You're going to get it at a lower rate, and it's a function of risk. The other way I think of it, it's a function of liquidity, right? We all know how much slower our residential land deals transact. In the commercial world, there are a lot more buyers, and deals can happen more quickly. And the view is that prices move slower, so a lender looks at it and views it as less risky to be in a position where they have a property that's easier to liquidate.
Okay, we got Andrew has a question.
So for hard money loans for residential, when you say low leverage, how low typically?
It could be anywhere from Sims. I'll let you comment on this too. It could be anywhere from 33% roughly, so down here, to maybe 50-60% on the higher end.
And commercial, it's
Commercial, if you have a 50% leverage loan, it's almost like why bother? I mean, there are guys that would have a multifamily property, let's say, and have some 50% permanent loan on there, just kind of anti-debt, but they have a little bit of debt just to juice, because the whole point of debt is to juice your returns. Mm-hmm. So it impacts returns somewhat, but generally speaking in commercial, 60 to 75%. Well, and that's what's important. Bridge and permanent's a little bit different. Permanent would be 60 to 75% is probably a good fair way. Bridge loans, sometimes you can get up to typically 75-80% of cost, because the whole concept with see how I like the whiteboard here.
Yeah.
The whole concept of
it comes off.
my bridge loan. If I have a $10 million cost and I can get a $8 million bridge, the whole theory is, and this is again, we could spend a whole session on commercial metrics and how lenders look at things, but the whole concept is if I'm buying for 10 and I'm getting a bridge loan because I'm adding value, ultimately this thing should be value-wise, let's say $12 million. So now my $8 million on my $12 million is only 66%. So even though it seems as though they started off in a really high level, they're kind of underwriting this based on, well, what's my takeout? And it's not just here we're at 66% loan to value. So this is 66% loan to value, but it was 80% LTC, or we call loan to cost. Okay, so getting back to here, the bridge loan is very similar to hard money, and that's another thing we'd say would be hard money. And where bridge loans could be priced, I mean, sometimes they're priced anywhere as low as if you had a big deal, sexy sponsor, I mean, this could be in the 3 to 5% range. Generally speaking,
Not in land though.
no, yeah, I'm kind of going up to commercial. I mean, so
And you've been
to hard
raping
money.
these people.
Hard money, baby.
So 3 to 5, and then if it was a just a more of a normal deal, it might be 5 to 7%. And this is we said 1 to 3 years because generally there's a period of time where you need to do something. Hard money, as you guys probably know, it's been compressing because there's so much competition out there, but it's generally double-digit rate. I mean, maybe 9, but let's call it 9 to 12%.
And when the market's crappy, 15.
Yeah, I mean, it could be. Sims, what have you seen the high end? Have you seen as high as 13, 14?
On resi?
On hard money, yeah.
Absolutely.
Okay, so this, we can call it 9 to 12% plus. And then as you also know, there's points with that. And these guys will rape you on points.
You like the term rape, don't you? Because that's what they've been doing.
Let's call this anywhere from 1 to
5.
4. Yeah, 5. I was gonna say 4.
But our
That's
money's way
close.
too cheap.
Yeah.
3 on the way in, 2 on the way out.
Well, you can imagine if that's a short-term deal, what those points can really have an impact. And also, as we said before, do you have a question?
Can I stop you here?
Yeah.
Because I think there's a really, really important point. And I don't know if I made it last time we talked about this whole session, this whole topic. And that is, why in the world, why, if I'm sitting at the table here, I'm wondering, why in the hell am I out getting a hard money loan at 12, 13% plus 1 to 4 points? Why would I do that? And the reason I think I would do that is because my equity is requiring even a higher return. Fair enough or no?
Well, I don't know if that's totally fair
Well,
because the equity doesn't want to sit behind that hard money loan. I mean, I think one of the reasons why you're doing it is because you simply don't have the money. You don't have $10 million.
You don't have the money,
Right,
you don't have the
but-
entitlements, you don't have whatever.
Let's flip,
Can't attract
wear your residential hat for a minute.
Yeah.
And correct me if I'm wrong, Sims and Dave, but in the residential world, I think the guys are looking in the land business. Let's get really specific now, and that is the deals that we typically see here in our business, where guys go out, tie up property, go to entitle the property, and go to flip the property to a home builder. Those kind of guys are looking for over a 20 unlevered IRR kind of return, right?
And a 2x return.
At 2x, and but let's just stay with return versus return for a minute.
Yep.
They're looking for over a 20%, let's call it, forget IRR, let's just call it over a 20% return, and call it 25. They're looking for a 25% return on their equity, so now the debt at 14%, 15% is cheaper than all equity.
Yeah, it's a fair point. I mean, you have to look at so the whole point of leverage is if your cost of capital is lower than your unleveraged return, then that's what we call positive leverage. I mean, you would never, if say your unlevered return was a 10 and I'm borrowing money to 12, doesn't generally it's not going to make sense.
Right.
But I think the point you're getting at is my unlevered return is a 17, so therefore I can afford theoretically to pay 14 for the debt because that's gonna. I mean, think of a scale. If my unlevered is a 14 and I cost money to borrow to 14, my levered return is going to be a 14. But if my unlevered is a 17 and I cost to borrow is a 14, then my levered will be a 22, 23.
Yeah, positive leverage.
Positive leverage.
Juices your return.
Now, hey, Dave,
Yeah.
what I would say, Jeff, and answer your question is from a purely finance perspective, you guys are absolutely right. I think the reality of it is when you look at residential land and hard money, what we rarely ever see is any institutional type equity willing to sit behind a hard money loan, which means the focus is less on trying to lever their return to get into the mid-20s, which is what the private equity would require, and rather instead more a function of the fact that they just often don't have any other source of capital.
Right.
Right, they're tapped out on their own equity. They either don't want to bring in a partner, so they keep the whole deal to themselves, or they can't bring in a partner. Hard money also often, and it's maybe even more applicable on the on the commercial side, but it's where people go because they had credit issues in the past, they've given properties back, they're not financeable by a cheaper capital source. And so I think there are a lot of more practical reasons about people's individual situations that drive them to hard money in residential land, especially than there are about just the straight up finance side of it.
Yeah, I agree. And that was kind of what I mentioned before. They just don't have the money, and you got to close in 3 weeks, and you could, keep banging on the doors of the country club and getting your buddies, but A, that's difficult. There's no certainty of it, and then ultimately it's going to cost you more money. So some guys say, well, I don't have $10 million, but I can scrap up $4 million. So now I need to, or $5 million, so now I need to go find $5 million to round out the capital stack and to make the acquisition. So
Can we expand on this whole concept just a bit and
Yeah.
touch on, because I don't know if you guys remember, I don't know who was listening or who was with us last time we talked about this concept, but as you look at your your capital stack, and you have debt and you have equity, can you kind of just like superimpose now Tim McGowan, who's coming in, and says, I got 1,000 lots in Corona, and, I need to raise money. What does this, I'll call him the sponsor, what does that capital stack right there, typically, can we touch on what the sponsor puts into that capital stack?
Yeah, I'll get to that next. Yeah.
Okay.
So let's wrap up. And so this is what's fascinating. All this conversation we've talked about is just debt, and now what you're getting to is now the equity side.
Yeah.
And so I think the thing that I want you to get away from, we want you to come away from this talk, is that you guys, when you're looking at the $10 million of cost and your $11 million of revenue, well, okay, it may cost $10 million to do what he needs to do to improve the property, and to buy the property, but what's my cost of financing? And not only the leverage and the rate and the points, but as we talked about earlier, I think what's really important, perhaps some of the deals you see, is that lockout provision. Because a lot of people don't incorporate that. They say, I only need the money for 3 months, so it's only going to cost me so much of interest. And as I mentioned earlier, to get 6 months, it would be a coup on two of these deals we're working on. If we can get a 6-month lockout, we would be thrilled. And the sponsors has to realize that that's the cost of doing business. But a lot of lenders may say 9 months, even 12 months, and then you have to factor that cost into your overall cost that ultimately would squeeze that margin.
And is there a way around the lockout by, prepaid interest or minimum 6 months interest, or, can you get around the lockout, or?
Well, you can get around a lockout by just...
Effectively the same thing.
Yeah, just by knowing that I gotta, no matter what, if it's a 6-month lockout, I gotta pay 6 months worth of interest. Okay, so I can't stress enough, how those costs are impacting what ultimately, and with margins as tight as they are right now, you don't have a lot of room for increased costs. And that's what we see a lot is this is moving. This is a very dynamic of what lenders are willing to do out there, of how high up the curve, and right now they're actually retrenching. So they're coming lower down the curve and probably charging a little bit more money, other than the exception of there's so much competition in this space that they are kind of beating each other down. So this is all debt. Any questions on debt for everyone out there before we move on to equity? Okay, so then you look at
Dave, does it make any sense to talk about participating debt, or is that just not even?
Well, we may get there.
Is that nothing you see in the
Well,
market?
we may layer that in later once we talk about. Well, let me just quickly talk what Jeff mentioned, and we'll go back if we have time. The capital stack can also be broken into, there's sometimes a third layer here in between the debt and the equity that can be called mezzanine money, participating debt, preferred equity. They're kind of all the same thing. There's nuances that make them slightly different here and there, but that's a third slice of the capital that is a hybrid of both debt and equity. And I think for residential, a little bit less, although there's some participating debt, but probably a little bit less pertinent. So for now, let's get into just debt and equity. So I think to Jeff's point is, Tim McGowan comes and he's got a deal, and it's $10 million, and we say we can go get $6 million of debt for you. Now you need $4 million. Chances are Tim doesn't have $4 million either. He not only did not have 10, he doesn't have 4. And so he's then has to go out and raise that capital. And it's amazing, as you guys probably know, people buy big deals with very little money of their own. It's you may have seen OPM, other people's money. And that is the concept of that real estate, guys, is the less money that they can put in on their own, generally speaking. Some guys have the money and want to put it in and make more money on their money. But generally speaking, if you're a developer, the concept of not using a lot of your own money and getting fees and having a big upside,
Perfect.
that's perfect, exactly. I mean, we always laugh like, hey honey, guess what? I got no money in this deal. We're making $500,000 a year in fees, and we got this huge upside potential. I mean, that's kind of what they're looking for. Now, so let's break up this equity. So generally speaking, if it's a $4 million, how, and we're kind of jumping right into it right now, but I think it's important for you guys, is the equity structure of a deal. And the general structure is a 90-10 and what's called a 10% co-investment. And the co-investment is the money coming from the sponsor. So in this case, they're going to say, okay, Tim, you got to put up $400,000. And to that point, think about that, $400,000 in a $10 million deal. It comes out to about 2.5% of the entire capital stack. So a very small amount. And then the money is going to put up $3.6 million. So $3.6 million from the investor and $400K from the, and this is, you've heard all these terminology, but sponsor, developer, operator, a lot of different, principal, a lot of different things you can call that. Now, once these guys put this money in, and I like to draw it like this, because this is the stack of priority. Priority of payment is another thing you need to think about. The debt, any money that comes in the door first goes to the debt, because they have priority of payment over the equity guy. And just like we drew this little middle slice in here, the debt would have first priority, this person would have the next priority, and then the sponsor gets their money.
Perhaps now would be a good time to throw in that statement about debt eating like a bird.
Eats like a chicken, shits like an elephant.
Thank you.
So, but watch this. I'm going to draw this line like this, rather than horizontally and have people priority. The general structures you guys may know is what's called pari passu, and that's another terminology that PARI-PASSU, I believe, and that means your money is as green as my money. Everyone's on equal footing, and so therefore, when that'll make you sound smart.
But there's other forms too that you're not exactly on equal footing too, right? If the deal is structured so that your investor's taking first and then you're taking after as a sponsor.
Absolutely, that would be what I would call preferred equity or mezzanine, and that's where I would draw this line horizontally to say, as money comes in the door, it's first going to this guy, then it's going to this guy, going up the kind of ladder. But then when I draw a vertical line,
It's going equal.
it's saying, it's going equal. So for every dollar that comes in the door, we're going to break that money up into a 90-10, because that's what the co-invest was. You put in 10% of the money, I put in 90, so when a dollar comes in, I'm going to get 90 cents, you're going to get 10 cents. And this is 90-10 is kind of the basic bare bones. You will see some, when the market's hot, you'll see this move to a 95-5. Now the more competition, the capital, and of course the sponsors want to put in less money, so he's asking, how about a 95-5? And most capital guys will be like, that's just not enough skin in the game. I mean, you hear the capital wants them to have their interest aligned or to have skin in the game. You'll also see if markets move the other way, you might see an 85-15, perhaps even an 80-20. But the standard off the rack that everyone's accustomed to is kind of a 90-10, 10% co-invest. So then you look at the structure thereafter, when you have a 90-10, you're splitting everything 90 based on what your co-invest was to a preferred return. And so let's just say we're doing a, I'm gonna erase this one here. So a lot of what we'll talk about is it's 90-10 to a, let's say a 10% preferred return, to a 10. And then once we get to that preferred, so what the money is saying, hey, we're all equal, get me to a certain number. And then once you get me to a 10% return, and that is not only, that is a 10% return on my money and return of my money. So that's, I get everything back, and then at that point it's like, okay, you've done your job. You've made it so that my risk is, for the most part, gone away. Now you probably heard the term promote, okay? So now you worked your way into a promote. So kind of a typical deal, and this is, Sims, perhaps correct me, commercial is a little bit different than residential, but roughly the same. And these numbers go all across the board. And this is the negotiation that takes place between equity investor and the developer. But maybe it goes to a 70-30. That would be, in the simple form of talking about it, a 20% promote. Because I only put in 10% of the money, I'm getting 30% of the deal, so that would equal a 20% promote. And then you all may have heard a waterfall structure, because then you're going into a waterfall where it's 70-30 to a, name the number, but let's say a 16% preferred return. Or not preferred return, but it's a return. And then after the 16, let's just say we get to a 60-40 to a 20, and then we'll go 50-50 thereafter. Now, I say 50-50, you don't get there a lot in residential. I think you may get there more than commercial. The old school guys, you hear like someone who's been around the neighborhood for 30, 40 years, what they want is they want an 8 pref. They want to put no money down. They want to do an 8 pref and then a 50-50 thereafter. And we get these all the time. We'll get that's the deal I'm looking for. And that's the deal I've always had. And that's the deal you may get at Big Canyon or from your neighborhood buddies that have been investing with you for 30 years. But when you go out to the institutional world, your pref isn't as low as an 8. And you're not jumping right to this 50% promote, or if you put 10% of the money in, it'd be a 40% promote. You guys following how I'm getting a promote? So here, this is a 30% promote. This would be a 40% promote. And then this is just a waterfall structure. So I was going to...
Fun point about this waterfall structure, by the way, guys, it is complicated, and I'll tell you the first deal we did out of the recession with a promoter, when we sold the property, it was fun that the promoter didn't know how to calculate his own waterfall. It was so complicated.
Yeah, and it's...
So we had 3 different guys running calculations.
Absolutely. Like we said, I mean, these things are really easy in theory, but they also can get super complex. And to Jeff's point, I've heard multiple stories. You have all the different parties involved arguing over what, how to calculate that waterfall structure. And it gets, you can imagine in the Excel model, it gets quite complicated as well.
We had 3 different runs on it. We decided we just got close enough, and we just
split
the numbers.
Yes, exactly. Split the middle.
Exactly. Yep.
So I wasn't going to get into this right away, but since the question came up, we got there. So I think preferred pari passu, preferred return, promote, waterfall structure. Those are all terminology. Is there a question out there? So I think more important for you guys than getting into the weeds of the waterfall structure is to understand what equity returns, what returns this money needs to see in order to make a deal worthwhile. Because there's 2 things to keep in mind from the equity perspective. One would be, I'm going to get rid of all this debt stuff now. You guys, I know, operate off the margin. and it's a terminology that's used a lot, I guess, and I think you also know IRR to some extent, at least IRR, internal rate of return, and that is essentially similar to a yield at the end of the day. Like, you know, if I get a 20 IRR, that means over 3 years I'm making 20% each year, and that incorporates when money's coming out of my pocket, when money's coming into my pocket, and so that metric is extremely important, IRR. Except to take that one level further, IRR has to be, I heard someone mention earlier, it has to be looked at in conjunction with what's the slang term would be multiple, which is really your equity multiple.
We got an argument how that was even calculated.
That one should be pretty easy.
It's just,
I mean, so what a multiple is how much money am I making on my money? So if I invested $4 million and I get $8 million back, including my 4, so I made 4 a profit, that's a 2 multiple. And it's
double your money, right?
Yeah, double your money. And that's where it gets a little screwy, is you think that I only got 1 times more of my money, but it's a 2.
That was the argument.
Yeah, and if you turn 4 into 12, that would be a 3 multiple. You have to incorporate your own money into that return. So the reason why multiple is so important is because the term that you'll hear with IRR is that you can't eat your IRR. So for instance, in 1 year you could have a smoking deal that someone says it's a 35% IRR. But you got your money back in, I was going to say 6 months, let's just say 1 year, okay? But even sometimes people try to spin an IRR of, that's less than a year, but then your multiple, and let's just say, and let's bring these numbers down a little bit. Let's say it's a 25 IRR. So you guys think, oh, this deal works for everybody, but your money is back within 12 months. So this 25 IRR is a 1.25, and this X is kind of what people do for the sign of a multiple. It's a 1.25 multiple. For a lot of guys, and we'll get into like the return thresholds, what people are looking for, they're looking to make more on their money. From there, it's similar to the lender who does a bunch of work and doesn't want their money back right away. He's saying, I don't want to do a bunch of work to get just 25 cents on my dollar. I'm not making enough money on my money. Now, different people need different requirements. Some people will say, in fact, I'm more IRR driven, I don't care about the multiple so much. But generally speaking, you guys, when you look at these deals, especially these smaller short-term deals that produce a really high IRR, you have to recognize that isn't always favorable to the investor because their money's not out long enough to make a good multiple on their money.
I'll mention, guys, we just went out with a 1,000-unit master plan, and Devin did a lot of the underwriting on this, but for what it's worth, it was the Royal Paul Ranch project, and what we heard from a number of very qualified sponsors was on a 1,000+ unit master plan in the Inland Empire today, in today's market, you've got to have a 2 multiple. If it's less than a 2 multiple, it's probably not going to attract the capital needed to do the deal.
And that is, do you have a question?
Yeah, I wasn't, just say for your typical home builder deal, public home builder, is that why they're more interested in their IRR and not necessarily the multiple because of the way they get their money?
Say that again, the typical home builder deal.
They're more interested in the IRR, hitting their IRR as opposed to the multiple, or because of the way they get the public home builder, because of the way they get their money.
Yeah,
I think
yes,
I think generally that's a fair statement.
I think it is, yeah.
It doesn't really cover everything because especially with the publics, they're also factoring things in like how many units are they selling? How's Wall Street going to interpret that? And some other metrics that maybe are not entirely based upon necessarily profit or IRR. But as a general rule of thumb, I would say yes, they're more focused on IRR than they are on multiple.
What we find is they're focused on the IRR. Typically nowadays, it didn't used to be this way 10 years ago, last cycle, but now they're more focused on IRR. And then secondly, the profitability of the project, in terms of just pure profit, which I guess would be similar to a multiple in concept. But you're right, our publics are driven primarily now by IRRs. Not all of them, but the vast majority of them.
And the publics have, like we said earlier, have their own, who knows what games that they're playing and what's important to them from a metric standpoint when analysts look at them. Yet the private investor guy is gonna be caught up on these and you know, it's a good combination. I don't know how much does Seidner worry? Do you guys worry much about multiple?
We do. We've turned down a few deals because we couldn't get enough, we couldn't get the multiple loans, hard money loans. We couldn't get enough money back to justify the time spent. So maybe the return was really high, the IRR was really high.
Exactly.
But you know, you end up investing, you know, $3 million and you make $100,000.
Right.
Okay, forget it.
Yeah.
It's just not worth it.
Yeah.
And that's where your minimum duration of your loan comes into play.
Exactly.
Where we put a 6-month minimum on our loan program, because we found that got us enough money typically.
To make it worth your
to make
while.
it worth
Yeah, and here's what's other important thing to note with these, and this is where it's almost like a Goldilocks scenario where you need these things to line up, is as time goes on and IRR goes down, time is the enemy of an IRR. I mean, that goes back to, you know, if you do a 6-month turn, and then some people say, I got 100% IRR, because they're saying I got my money back in 6 months, and if I was out for a year, I could double, it would have been this extreme IRR. But the multiple though, generally, and certainly in commercial, because you have income that's kind of adding to it, but you could also say a longer residential deal has more lots, that's gonna give you more profit, that the multiple grows over time, the IRR shrinks over time. So what makes it tricky is there's this perfect world, a lot of guys are like, oh, the IRR is great, and keep in mind, investors are always looking for ways to not do deals. Oh, the multiple's too low. Oh, the duration's too long over here. I mean, but if you come up with this perfect 2 to 3 year kind of a deal, 2 to 4 year deal, where the IRR still stays high, the multiple is big enough to make it worth their while, that generally is the institutional sweet spot where you've kind of hit on everything.
Dave, this is absolutely something that's very, very practical for us guys that are working in the inland markets like Inland Empire, Bakersfield, Sacramento. And that is that what we've experienced over the last 3 or 4 years is the promoters have, quote, gone out of the money. What does that mean? Promoters are out of the money.
Yeah.
Can you explain that concept?
Absolutely.
So we harp on, as brokers, we should be talking to the money. The reason we stress talking to the money is because of this concept that Dave's about to talk
That's
about.
a fantastic point. So you can imagine if a deal, and what you guys are seeing a lot in your deals, costs are higher than budgeted, and the investment duration has extended longer than what anyone has anticipated.
Too expensive and too long.
Exactly. In which case, what does that do to this IRR? It drives this IRR down tremendously. And then when the IRR is driven down tremendously, he's not getting to his promote, because the deal is what used to show 22 on paper, and this guy's looking at a bunch of money. As time goes on, the IRR is getting lower and lower and lower, and then all of a sudden he's like, well shit, I'm not even gonna get my promote. So his attention then goes on to other projects where he's gonna get his promote.
Well, it depends if he's getting a management fee.
Yeah.
Typically in that scenario, correct me wrong, Sims, if I'm wrong, but I know in our structures, we cut the management fee off.
I know.
Yep, well, Jeff, that's another key point, is the minute those fees stop, they stop paying as much attention.
Oh, yeah.
But the other thing that's also going on, which is important to remember, is when the deals aren't performing as expected, the JV equity partner gets significantly more involved. And at the end of the day, they hold the right to make or at least approve all major decisions, of which the sale of the property is one. And as soon as the deal starts going sideways, they're going to be much more focused on overseeing that process and when that decision is going to be made. So the worse a deal gets, the less influence the sponsor has in anything that's going to be done.
Which is critical as brokers to understand who controls the deal.
You know, as a company, this is kind of a side note, all of us should be talking more to the capital. I mean, we all thought, you know, sponsor, but the capital guys have a bunch of business for all of us in our respective businesses because as Steve mentioned, a lot of times they do have control of the property and they are making the call as to who's gonna list the property and sell it. They are making the call as to who I should hire to refinance the property and put on a different source of capital. But I think a lot of times people are intimidated to, I can't talk to Oaktree, you know, I'm comfortable talking to McGowan, but not to Oaktree. And really critical, especially for you guys with these deals that are probably sideways, a lot of them, that where the capital is having more influence on the direction of the next few months or years of that property, that you guys are in front of those people.
And when the world goes completely in the crapper, and I don't know how good a job we did in the last downturn, was talking to the lenders.
Yes, because then all of a sudden, talk about out of money, then first the sponsor's out of money, then when this value drops low enough down to here, then all the equity, Oaktree's out of the money. And so then this guy's left taking over the responsibility and having to figure out what to do with it.
And to Doug's point, in the last recession, we knew the promoters, some of us knew the equity, very, very few of us knew the lenders. And so we were playing catch up in the last recession, big time.
Well, that's
we were not positioned well with the lending community.
Interesting. That's where the synergy of the platforms, will be great, because we'll have access to the lenders and the equity guys. You guys will have the sales expertise. We're going to be able to come as a team and say, hey, we can do an analysis for you to determine, is it better to refinance, is it better to sell, and run that scenario. And then if should they choose to refinance, let's talk to Landmark Capital. Should they choose to sell, let's talk to Land Advisors.
Exactly.
Okay, I think this might be kind of a dumb question, but whenever we have a deal and we're dealing with a seller and they say, well, who's their capital partner? That's their equity partner. Do they ever ask, do they care who the debt provider is? I feel like I never witnessed those conversations, but do they?
Steve, I'd love to hear your comment on this. I mean, they care, they want to know, but generally speaking, it is who, they look at the equity as kind of the sophisticated money. And the equity wouldn't come down and put a hard deposit and a lot of that stuff unless they knew they could get to the debt. So I think the first and foremost, that if you're a seller, you're like, okay, who's who's driving the ship here? Because this guy, the lender, is just going along for the ride.
Okay.
But these are the people that at the end of the day are going to be closing on the property and bringing in the $10 million, however they want to come up with the $10 million. But it's also important to know who the equity is, because if it is Joe, let's say it's Kidder and Spindler as the sponsor, and our equity partner is some jack off guy, then the guy who's selling is he's going to question, can you get the debt? Or if it's Oaktree, it's like, okay, don't worry about it. I know you guys can get the debt. I don't need to dig into that.
You're legit, yeah.
Yeah, you guys are legit.
Well, I would want to know, is it a private money, a hard money guy, or is it an institutional lender? Because obviously they have different characteristics. And when that shit hits the fan, they're going to probably act a little differently.
But I think, to Wendy's point, I think if I were to rank the importance, the promoter's number one, the equity source is number two, the debt is number three, in terms of who I want to know in a normal market. If the market's gone to hell in a handshake and these guys are out of the money, then all of a sudden the lender becomes the most important guy. But in today's market, I think what everybody's really curious about is, where'd you get your equity? Who's your equity? And to make that point, you guys actually on your commission schedule charge 3 times as much to find the equity as you do to find the debt. Is that a fair statement?
Absolutely. Because it's it's a smaller piece of money generally. I mean, if you bring this letter here, you got 4 versus 6. Sometimes it's 3 versus 7, but also because it's more challenging to bring that capital in. So we'll, as Jeff mentioned, we'll generally start at 3 points for equity, and then 1 point for debt is pretty common, and then that mezzanine in between is 2 points.
And that's simply a percentage of the loan, of the equity amount. You raise $1 million, it's 3% of the loan.
Yeah.
So if I was a promoter, let's just say, what's the order of this? Do you lock up your debt first or your equity? Or does one follow the other at the same time?
It's a great question, and it goes both ways. And sometimes and Steve, I'd love to get your take on this and add to it, but it goes both ways. Sometimes you say, I don't know how I'm gonna get the debt. and I don't have anything, I'm trying to think of some real life examples we can look at right now. But we have that debate a lot sometimes internally. It's like, do we go for the debt first and know that we can get the debt, and then if we have the debt, then we know we can get the equity? Because the equity a lot of times doesn't want to be behind certain debt. So let's lock that up, and then we know we can get the equity. But there are times when you say, hey, I can get debt all day long on this property, but are the returns there for the equity? So then you got to kind of go from the other direction and say, hey, Mr. Equity Guy, if I can get debt in this zone and produce these kind of returns, does that work for you? And then to lock up the equity first, knowing that once that's locked up, this will be easy.
So it's very much a
Yeah, I mean,
specific.
I would follow up and say there is no yes or no answer to that. It's completely the chicken and the egg. Every deal's a little bit different, and I think as much as anything, it just depends upon, in a lot of ways, the quality of the sponsor that's involved.
Can you tell to some extent at what stage of the cycle we are based on that? Because, I guess it depends on the market and the deal, but are you seeing a lot of equity being wiped out of deals and, lenders becoming more involved now, or are we still a ways away from that?
This is where commercial and residential may be different. I hear all the horror stories of duration, people going past their budget, past their time, and I think there's been a lot of bad residential deals over the last 5 years.
Is it safe to say that if a residential dirt deal is beyond 3 years, that equity is more than anxious at that point?
No.
That's not
no,
safe?
not necessarily. It's a function of what the original business plan was.
I
right?
understand.
So,
okay.
I mean, the longer you get out, the more the risk is certainly of them getting nervous. But if it's a 2-year business plan and you've gone on to year 3, then yes, it's absolutely getting more nervous. But on some of these bigger scale deals, they're expecting to be into them for 5 or 7.
And so going back to the question of where we may be at the cycle, and I'll make this more of a commercial bent right now, but I think it applies across the board, and this is where I am not naively optimistic, because we obviously have had a run and things are priced to perfection. However, I'm less concerned. I don't see right now what we saw 10 years ago, because I was saying before, they're giving you 60, I'll give you 65. Oh, they're giving you 65, I'll give you 70% leverage. And the leverage was going higher and higher up the curve, which made everything more risky. And one thing that has been the positive of this cycle is that lenders have remained in check. I think because they got burned so bad, we all have short-term memory, but underwriting standards, and there's other metrics we haven't talked about yet, but going back to the leverage, there's other metrics that were always in place. Like, you don't break through those barriers, and then in 2006, breaking through those barriers, like just 1 month after another. Whereas now, not only have we maintained those metrics, but if anything, right now, the debt world is retracting some. Yeah. So getting a little bit more conservative, which tells me that we may have other problems, but we don't have an over-leveraged problem like we did the last summer.
Is this an interjection of regulated versus unregulated?
Certainly. Yeah. I mean, I think it's a combination of they got bit and they're a little scared, and then the regulation absolutely has an impact on capping what these guys can do. Sims, any other thoughts on that?
No, I agree with what you said.
Okay. Okay, so I think we talked about IRR, we talked about multiple. Again, this is probably interesting for you to know, but a little bit, I don't see you guys getting into the weeds on this a whole lot. I think what's important for you guys to understand, and we'll go back to that, is what returns need to be hit. Remember, the cost of debt is impacting what the overall cost and the margin is going to be. But then, once you look at these returns, what is acceptable for investor or not? And
can I ask one question before you get into that?
Of course.
I think this whole waterfall structure is going to become increasingly important, and I speak to the dynamic that we're experiencing now, where we have these promoters, we have these equity partners who haven't been able to get out and aren't willing to live with the lower return they don't have the debt pressure perhaps, and so I think we're gonna end up structuring more deals that look more like a venture. And in those, these are gonna become that much more important. Perhaps maybe too sophisticated for that particular property owner, depends on the property owner. But I believe this is gonna become a bigger subject matter for all of us because we can't get them out at the kind of number they were hoping for, so that deal structure is
I
gonna
see what
be
you're saying.
more creative.
So, yes, and then, hey, you bring up a great point, and I've been saying this long before I was involved in land advisors and putting more of a residential cap on, but the person who can figure out this type of structure between sponsor and landowner is brilliant.
Yeah.
Because then you could say, I can't get to your number, but how about this? I'll keep you in the deal, and we'll split it up this way.
Yes.
And at the end of the day, 3 years from now, you're looking at 2-3 times more money than if I gave you the price you're looking for right now.
Yeah, you wanted 150 a finished lot, I can't get you there, you know, the market's 120 today, but if we do this, you throw your land at here's where you can conceivably end up.
Yeah, I think
That's where I think this discussion becomes that much more important for us.
huge opportunity there. And then and that brings up a good point is we should maybe over time spend more time on this because the risk of that I would see is look at how you guys are real estate guys and we're having to talk this over and over. The general farmer seller, I mean,
he could care less.
He could care less. You're going to get over his head in a minute. So
Yeah.
I think one thing that we could work on as you see those opportunities is how do we just lay this out in the most simplistic
Capital
way
for
possible.
dummies, I mean, truly.
Exactly. So that they can understand it, and at the end of the day, see that hey, you making X 2-3 years from now is better than making whatever now.
Our ability to talk through that and explain it as simplistically as possible, I think, is key.
Yeah, agree.
Okay. Sorry, go back.
That's okay. So let's get into what the return expectations are for different kind of risk profiles. And Sims, I'm trying to dig up your email here. I'm looking at my phone, but we kind of break it down to 3 different deals. One would be just a raw land entitlement deal. One would be your land development deal, and then is your home builder deal. And as you know, it's increasingly less risky theoretically as you move across that process. Now, for the entitlement deals, for the most part, you're not going to have leverage on it. I think, and even if you do have leverage for all these deals, I think the fundamental thing that you'll hear Steve and I say is, what's the unleveraged return? I don't want it to be artificially inflated or masked by any sort of leverage. Tell me what the unleveraged return is.
Dave, maybe let me emphasize on that a little bit.
Yeah.
At the end of the day, if you really step back and look at it, well, a lot of people make decisions based upon levered returns. Truly, the best way to judge one opportunity against another is how it looks without leverage, right? Because when you start to put leverage on an asset, it significantly increases your risk. And so at a very, very much a baseline, Dave and I always try and look at things and saying, before you get any leverage, how does it look, and how does a residential land deal unlevered look as opposed to buying a triple net leased, Jack in the Box, for instance?
Yeah,
you try and compare things across that spectrum.
Absolutely. When you have apples and oranges and grapefruits, that's the cleanest way just to turn all into an apple. And to judge.
Dave, there's one other point I want to make too about land, which is, because you're right, on entitlement deals, you're very rarely going to see debt, and ideally you really don't want to. And the reason would be, and Adam and I talked about this a lot, unlevered land is still the most leveraged real estate investment of all.
Say that again?
Unleveraged land.
Unleveraged land is still the most levered real estate investment of all.
Meaning, hey, I'm going to draw that out for you. I think what he's getting at is just the volatility of land and how much it can move.
Okay.
So, you could buy something for $5 million unleveraged, but that thing could move to 2.5 real quickly, as you guys know, and not be liquid. And so, God forbid, if you put $2.5–3 million of debt on that thing, you're wiped out. So
now, Dave, even more than that, it's that the end user of land is the home buyer, and the home buyer is using as much as 97% financing to buy that home. So changes just in the mortgage market alone, and moving the top line value of a home. If a home drops from $500,000 to $450,000. all the other costs in that short period of time stayed basically fixed. So all of a sudden, 90% of that 50 grand price drop comes off the dirt.
Right.
Everyone get that?
Yep.
Okay.
Yeah, the other way too.
So, what's that?
Don't forget that way too.
Yeah,
Absolutely. And that's where you can make a ton of money from a land perspective. But getting to the point is that most of these deals, land should be unlevered, or if you do have any kind of debt on it, pretty minimal. So, based on returns, then, so what do you guys need to see when you're underwriting a deal and you're trying to tell your seller when he's coming up with some ridiculous price, and you're saying, hey, this is what money needs to see. We are on land, we're talking unleveraged. And as someone mentioned earlier, kind of a 2 multiple is a really important number. Maybe, as Steve mentioned, kind of a 1.75 if it's more of an infill market. So for every $10 million you invest, you need to make $7.5 million back. And along with that, the 25 IRR that you guys are accustomed to. And that's tricky. I'm on the way here, I'm doing the math. It's like, how do those two numbers, this is where there's that sweet spot. I can get to 25 IRR if I turn this thing in quickly, but am I going to get to my multiple? And so for a lot of people, both of those metrics need to be checked to make sure that's a good investment. Now, on the land development side, Steve, what were you saying? You're saying 1.5 to 1.6, kind of a minimum multiple, unlevered, correct?
Yeah. Yes, depending upon the duration of the deal, how many lots you have, how big the scope of the project is. But certainly have seen situations where you can be as little as a 1.5 multiple if you're very comfortable with your costs, you have a shorter term duration, and you feel very comfortable about who the sponsorship is.
So my question to that is, since we're talking about the equity in a land development deal, what is the status of the debt world for a land development deal these days?
Great question.
Shitty.
Yeah.
Really shitty.
I knew the answer, I just wanted to make sure I heard it from you again.
Yeah, there's a hole in that market.
So why is that? I mean, doesn't that just then drive, everything up? If I'm
Yeah.
gonna do a land development deal, I want a 2x, or I want, whatever.
Well, what it effectively does, Doug, is if you can't get any debt, in order to get those deals to work, they have to be done all equity, and the cost of that equity is 25%. If the banks were stepping in and providing half of it, the cost of that half the capital stack would be 5 or 6. The thing is, the banks, for the most part, are not really a player in that part of the space. They are if they're going to have any development component to their loan, they also want to be doing the construction on the homes, because admittedly so, the individual homes are much more liquid at the end of the day than finished lots are.
Sure.
So if you don't have the debt component in the market, what it leads to is it ultimately is leading to downward pressure on land prices.
A lower price point.
Right.
Because the equity so expensive.
So
Exactly.
therein lies why we have virtually no private home builders playing, and I speak from the Inland Empire perspective.
Well, yeah, I mean, yes and no. I mean, if a private home builder has good banking relationships and they can bite off the right size deals, you can get good terms on the development component of that loan, provided you're going vertical on the product.
Okay, understood.
What you're having a really hard time doing is finding traditional land developers able to buy paper lots and take them to blue top or finish.
Well, yeah, I mean, how many traditional land developers do we actually have these days?
Well, maybe because of the
We
function.
I think we have a decent number of them, but I think what we're seeing is a lot of your clients are not going to be willing to part with deals at the numbers that the land developers will pay in order to make those projects move forward.
Exactly.
Okay, Andrew has a question, then we'll get back to your question.
So if we see someone in the market turning dirt, is it safe to say it's almost all equity then that's doing that?
Or, as Steve mentioned, like an A, D, and C loan. Okay, now we're going to move the dirt, but we're going to build. We're going to go all the way through.
Got it. But if their business plan is to, turn the dirt, sell finished lots,
Yeah, and
no
see,
debt in that market.
that drives into Amish's question too, is why is that, I mean, who are those players and why is there kind of a gap for that A&D financing right now, you think?
Well, from a banking perspective, I believe it has a lot to do with both with the perception of the risk and a lot of the new regulations. So many banks got burned so bad on the land development component. It's a little bit harder at times to say why that's the case when you move towards debt funds and the like, but I think, largely a lot of it is people just continuing to be nervous because they got so burned in at the last go around.
Yeah, I think it goes back to land having such volatility that they're concerned about. Now, on the flip side, which as we're talking about it, and Farrell has been banging this drum since the day he got there, is like we need to have an A&D loan platform because you can charge a boatload of money, very little competition, and kind of like we mentioned earlier on the commercial side, and this is where I'm speaking a little bit out of turn, but you're adding value. I mean, you're adding a good amount of value that if you can get to a finished lot state, ideally,
There's a premium.
there's a premium. However, I still think it comes back to that land has such movement that even that value that you're theoretically creating can get wiped out
Well,
real quickly if things turn the wrong direction.
We have guys considering improving the dirt right now, maybe for a possible premium, but maybe, more importantly, just as a means to get it sold, which is scary
Yeah,
that they're having to go that route, if they can.
because no one's
we're seeing
buying,
the same thing.
Yeah.
because no one's buying the
Because
paper
they're not
lots.
buying it, and
They're
they're
only
not
buying
willing
the
to buy
paper
at the
Right.
price they're willing to sell.
Right. So they have to
So
keep
they have to do it.
to take it all the way through, right? And that, another thing that we've seen, and I've heard Adam speak about it a little bit, and so I'm not going to speak as intelligently about it, but to the same point, is there used to be kind of three things of profit, right? Yeah, I can get to paper lots and I've made a little profit. And then I can do the land development, take the finished lots and make a little profit, and then leave some profit in for the builder. So everyone's taking a little piece of the pie. Now things have driven down, so tight that there often isn't room for all those people involved, let alone having the financing to get it all done.
So are we ever gonna see someone like a Lehman again that, brought all that equity, all that debt to the table to the likes of a SunCal?
My answer, Doug, is I hope not.
Yeah, I agree. I mean, I think we talked about earlier about
I hope not, because I think that created so many problems moving years down the line that we're still having to unwind, that we'd just be setting ourselves up for potential failure again.
Yeah, but look at all the deals we're able to do.
Yeah, Terry really wants there to be another lead.
It's all about me and all about now.
But it goes back to, and this is why I
One of the things we're still trying to work through from the last run-up is this belief that you sell paper lots and the builder takes all the land development risk with little to no return for it.
Right.
Hey Sims, just to check, we got that call in 5 minutes. And these guys
Yeah,
are,
I know.
okay. But that goes back to the point. That's why I think the silver lining that I see in the market right now is that people haven't kept going up and up and up and providing more leverage and lower costs. That as long as this is intact, does it impact velocity and sales prices and all that? Yeah, but rather than doing this and doing that, I'm okay with kind of flattening out a little bit. And I think longer term, that builds in a longer cycle for us as opposed to having a really hot market and then a awful market for a couple of years.
Yeah.
See, you gave us the multiple for a developer, but what type of IRR are they looking for?
For land development, we're still thinking Sims 25% plus on that.
25 to 30, yeah.
Did we lose Sims? He may have jumped off. We had an 11 o'clock call. So Sims still think it's kind of a 25 IRR. Now, I'm not again doing the math here. That is tricky. If you're trying to get a 25 IRR, but your multiple is only 1.6, 1.7 on a leverage basis, it goes back to this kind of the perfect sweet spot. And then on the home builder deals, we talked about kind of a 1.3 to 1.4 unlevered multiple. And I think that's the number that I see Adam and Steve constantly go back to. It's like, what's the unlevered multiple in this home builder deal? And then I can put financing in and everything else to get to some IRR that sounds like kind of 18 to 20 IRR with a multiple, once you have leverage on it, of like a 1.6 plus, maybe 1.
You're gonna send us his email?
I can, yeah, absolutely. So I think the best way to wrap up, since we're short on time, is then keep in mind then, all these numbers we're talking about have to be, goes back to that, if we're talking a 25 IRR, this, now I'm gonna tie back to here, and this is a good way to kind of wrap it up, and this is a deal level. You guys ever hear that? Deal level IRR and a deal level multiple. Because that is, and I'm doing X, deal level multiple, let's say 2. But once we go through this process and we do a promote, the investor's getting less than that because his money is being promoted off of. So this might turn into, for the investor, a 22 IRR and a 1.75 multiple. So the investor is always going to get, and that's really, I can't stress the importance of that, because you may say it's 25 IRR, but the investor needs to get a 25 IRR or whatever he needs to. So you need to think then, if whatever his metrics are, and that's one thing in that email before we send out, I'll clarify, is this deal level or is this net, when we say net to the investor? But because his money is being promoted off of, is the concept you need to understand, he's always going to be a little bit lower than what the deal level return is. And the sponsor here, it almost doesn't make sense because he's putting so little money in, but he will get a 55% IRR, let's say, and a 2, maybe a 3 multiple, because he's promoting off of the other guy's money. Now, if there was no promote, everyone would just get a 25.
So the deal level is really just to see if the deal works, and then you kind of take it a step further to see if it works for you as an investor.
Absolutely. Yeah, the deal level is first thing, and then unlevered deal, and then let's look at a levered deal return, and then let's put a split, and then what does that give the investor? And then, end of the day, that's where decisions are going to be driven. Yeah, Ian.
As we see like the economy as a whole continue to shift towards like a crowdsourcing kind of base with Uber and all that type of things, are we going to see something similar to that on a larger scale? Than I mean that's kind of what you do when you go out and get equity. You kind of crowdsource it, but in a more institutionalized way.
Mm-hmm. So, how do you understand that?
Can you
kind of
predict
like
the future?
Kind of like Indiegogo going real estate deal. Is there a future in that?
In the whole crowdfunding thing, is that? So yeah, I think so for sure. That's not going away. Now, it's going to have some hiccups. There's going to be a ton. That's the next legal wave. Just like TICS, Tenant Commons was a huge shit show that we're still coming out of. I think the crowdfunding thing is going to be a mess because you have a lot of non-real estate guys. Not only the companies tend to be more technology people than real estate people, but then you have Aunt Betty from Kansas who put her money into it, and then she doesn't understand why.
And that's all unregulated.
Why the money's gone? Yeah, right now it's all unregulated, so it's going to be a mess. But however, it makes perfect sense. If you can get out to a number of people and raise that money, and probably a better type. It depends on how institutional those guys get, but maybe even a more favorable terms. Absolutely. Now, right now, it's in such a nascent stage that the amounts of money that you're raising through that platform are really small. I mean, if you're raising $1 million, yeah. If you wanted to raise 5 to 10, the way it is right now, it doesn't work. And ultimately, this is kind of a side note. I think that we laugh about the crowdfunding thing is it's gonna morph back into institutional capital, because I think the crowdfunding guys are realizing that raising and there's different types of crowdfunding, but let's just call it the bigger guys who raise minimum $250. Raising a bunch of $250,000 checks from a whole lot of people is a lot more of a pain in the ass than just getting $10 million from one institutional investor. And so now these crowdfunding platforms are seeing institutional investors say, "Oh, you have deal flow. I want to look at your deal flow and just know that we're your investor."
Yeah.
And so the concept of the online aspect is here to stay, what I don't know if it's here to stay is it really gonna be pieced out to all these different people, to, you know, aunt and uncle and whoever else, especially with regulation and all that, as opposed
The
to
reporting and the.
just shipping it off to a big boy and taking the whole check and knowing that he's more sophisticated and that he can look out for his own investment.
But there are guys already doing this. I didn't really realize.
Crowdfunding?
Yeah,
Oh yeah,
for real estate.
yeah, absolutely.
I didn't know.
I mean, there's a ton, I mean, dozens and dozens of platforms, and a lot of them will get wiped out. But even the ones that are really have made it, you know, the Yahoos and the Amazon, so to speak, the guys that have elevated past everyone else, they're not raising big chunks of money. And the guys that are, it's because they have an institutional investor that just says, I'll take it off your books. And so really, they're a broker. I mean, I laugh. Everyone, at the end of the day, almost everyone's a broker because it's always going to somebody else.
Just a real quick question. I know you didn't really touch on it, you didn't really want to, but when does the actual waterfall payment come out? Is that the end of the deal, or is it throughout the deal when revenues come in?
It's throughout the deal, but generally speaking, you'll never get to the promote until the final thing, because, you know, any money that's coming in is like, so you have $4 million, and what you see in our models, you have this $4 million figure. And let's say you have to have a 10% preferred return. So every year, you have $400,000, let's say there's no money being paid. So then, at the end of the year, you're this, right? 4.4.
Oh, so you guys aren't running it off just a straight margin, you're running it off kind of like an IRR.
It's compounding, it's
Yeah.
accumulating, compounding. So then year two, you start at $4.4 million balance, you've got whatever this is, 44,000, and so then you got a bigger number. And so then when money is coming in, it's chipping away at what's called the capital account. And so it's really not until at such point you have a revenue event, meaning in commercial, a refinance or a sale, where then you can say, okay, we're paying down whatever accumulated balance that we had. And then once we pay down the accumulated balance, which is my return of my money and my return on my money, then we can start getting this promote section here.
So once revenue's actually coming in, you're trying to chip away at that capital account.
Absolutely, yeah, that's going directly, well, first it's going to the lender.
Yeah,
And so
it's gotta go
everything's
through
being
the
paid to
capital
lender.
stack to get
And
to
then once everything, the lender's satisfied, then additional money is going to pay down this capital account. And so this capital account is always growing or shrinking based on whether there's revenue coming, whether it's accruing or whether there's revenue coming in.
So it's below the line. I mean, the lender side, the lender payment would kind of be above the line.
Well, yeah, kind of. I mean, typically how we would say it is you have your NOI, and then below the line would be now your debt payment. So that's going to give you, once you have your debt payment, you then have, now we're going to get into commercial terminology, but net operating cash flow,
Yeah.
NOCF. And then once you have your net operating cash flow, then you get into the whole, I mean, we have, this is a huge part of our model, is you have the investor, and you've got the sponsor, and he put in X, he put in Y, and you have your individual capital accounts, and they're always moving. And then once you, again, get paid back the entire amount of the money, plus the entire amount of the preferred return that's been building over that period of time, that's when the investor says, okay, I can reward you now. You've got my money back plus my preferred return. Now let's switch it into, for every dollar that comes in the door, I'll give you 30 cents, and I'll take 70 cents. Man, a lot we could cover. There's a ton that we didn't even get into. I mean, we might even want to do part two.
Yeah.
But
I think so.
I think
Yeah.
we need a separate one just on waterfalls too. That would be
Yeah.
kind of